And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. Despite persistent worries about higher for longer inflation and the negative implications for technology stocks, the big money continues to pour into technology ETFs. All of the biggest tech funds have seen significant inflows this year, with one exception from a former tech darling. Why are investors continuing to put their faith into tech? Let's talk with Nate Geraci. He's head of the ETF store and an independent investment advisor. Also joining me, John Davi from Astoria Advisors. Also joining us shortly, Jim Davalos, portfolio manager at Horizon Kinetics, who runs an inflation ETF, and I want to talk about that as well. But Nate, let me turn to you. What's the reasoning here with these strong tech inflows? I see every broad tech fund, from the Spider Technology, the XLK, QQQ, Vanguard Technology, has seen inflows this year, even though higher rates usually hurt technology.
Yeah, and you could even broaden that out to the S&P 500 ETFs, which are all in the top 10 of ETF inflows. Those obviously are very concentrated in mega cap growth and tech. But I think what this gets back to is investors are viewing mega cap tech as a quality play. These companies have tangible earnings. They have cash on the balance sheet. And if you go back to when we were in a zero interest rate environment, there was no hurdle rate. And it was much easier to take speculative bets. But now we have short-term treasuries yielding north of 5%. I think that causes investors to rethink making bets on companies with earnings that are far out into the future. Investors want earnings and cash flow they can see now. And in general, that's what you're going to find in tech ETFs. It's almost as if it's a quality approach.
Yeah, that makes a lot of sense to me. Now, I noticed one exception here when I was looking at flows, and that's Cathie Wood's ARK funds. They're continuing to see outflows like they did in 2023. And what's the difference here? Why are investors pouring money into broad tech funds and not into Cathie Wood's? And by the way, it's not just ARK. I see the robotics fund. I see space exploration fund, ARK space exploration outflows, fintech outflows, next gen internet ARK fund outflows, right across the board.
Well, again, I think investors want earnings here and now. They want to see cash flow. And if you look at the types of companies that are in, for example, ARK's products, these are very speculative bets. And you're betting on something way out into the future. Investors aren't comfortable with that right now. We could have higher for longer rates. Obviously, rates are elevated right now. I think it remains to be seen what happens with rates moving forward. We have had some inflation data that has been hotter than expected. And so investors are shying away from those speculative bets like you see in something like ARKK.
John, weigh in on this. This seems to make some sense. I'm trying to figure out, why is Cathie Wood seeing outflows and big cap tech are still seeing inflows? And his point is the emphasis is not just on technology, but on quality in technology. And for those who don't know, quality is generally what? High return on equity, stable earnings growth, low debt to equity. There's a whole series of criteria for quality. But does this make sense, what he's saying?
I think so. I mean, I think you usually get like one bite at the apple. So if you buy like some unprofitable technology ETF, if it goes down 70%, you have a problem explaining that to your end client. Whereas tickers like Qual, the MSI Quality ETF, you're going to get, like you said, companies with stable cash flow, low debt to equity, kind of stable earnings growth. So those are tried and true kind of measures. So I think investors, in a new interest rate environment, like Nate said, when Fed funds is like 5.25, I think it changes the game for all asset classes. So
you run a quality ETF, right? ROE is the symbol there. Put that up. Maybe we can just talk about that a little bit. This is 100 large and mid-cap stocks, all equal weighted. How do you decide what's quality?
Okay, so we are looking for companies that pay dividends, stable cash flow, low debt to equity, good ROE, good ROA. Mm-hmm. Our issue though, and we sector optimize. So if tech is 30% of the S&P, ROE is going to have 30% technology exposure. Our issue with these broad market cap weighted indices is that you're putting a lot of eggs in just a small select technology stock. So we just say, look, we want to give each stock 1% weight and pick 100 of the highest quality stocks. And that's what our fund does, ticker ROE.
And we're looking here about your biggest holdings, Supermicro, NVIDIA. These are all well-known names. Cencora, tell us about that.
Yeah, so we, because we are optimizing against the S&P tech sector weight, we're going to have like 30 technology stocks, and each stock is going to have 1%. If a stock goes up a lot until the next rebalance, you may see some size drift. That's why Supermicro Compute is 2.3%. But it was like very important for us because of what you're talking about with flows. People don't want to be underweight tech, right? Tech is projected to deliver 40% of this year's earnings growth in the S&P, and next year 35%. So tech is the market is tech. So that is why I think, like, if you look at the S&P equally weighted index or the Russell 1000 equally weighted index, those will only give you like 15% technology exposure, whereas we're going to give you the S&P's tech sector weight 30%.
Yeah, because that's quality weights towards earnings growth too,
yeah,
right? That's
exactly.
a very important tilt that you've got here. Nate, this word quality we're throwing around, I follow the academic research on this. It's often mentioned as one of the few factors that outperform the market. You get size, generally small cap outperforms big cap over time. Value, generally value outperforms growth over long periods of time. Profitability and momentum as well, and quality is one of these factors that people seem to pay a lot of attention to these days.
Yeah, and again, I think it just goes back to the environment we're in, where there is some uncertainty moving forward as to whether or not the Fed is going to get this right. And it is possible we have an economic slowdown. In that scenario, investors want earnings, they want cash flow, they want things, again, that they can see and feel and touch right now. I really think it's that simple. What's interesting to what John was saying is if you look at flows into some other ETFs, we have seen a pickup of flows into something like the Invesco S&P 500 Equal Weight ETF, ticker RSP, or the iShares Quality ETF, ticker QUAL. And so you're seeing investors hone in on these sorts of factors.